What is going on, guys? Again, forgive me for the little bit of an absence. Work is just getting pretty hectic. Again, I do work at a Big Four accounting firm in public audit, so it can get a little pretty busy around this time of year. So you gotta forgive me for that. But anyways, figured I'd do an update on BRP stock because, as you guys know, it's a stock I'm personally invested in, and it's one that I've talked about a couple times on this channel. It's not like a massive position of mine. It's not my biggest stock by any means, but it's a reasonable part of the portfolio. Quickly, if you do want some commission-free trades on Questrade or some free stocks on Wealthsimple, two platforms that I both personally use and stand behind. Links to sign up will be in the description or pinned comment. Also, come join the Facebook group where we talk Canadian stocks and a bunch of other nonsense. Link to join that will also be in the description and pinned comment. But without any further ado, let's get into it. And so as of late, the stock is actually down 35% from its highs back in September of around $128 a share, I think it peaked out at. It's funny because I actually had a limit sell in for $131. And it just didn't get quite there, which is unfortunate because, man, I would have locked in some nice gains and had a great opportunity to buy later. But hey, you win some, you lose some, as long as the outcome is income. So now, obviously, with the stock down significantly, you're kind of noticing a theme on this channel, right? At least as of late, I'm covering stocks that are pretty beat down. The question obviously begs at this point with BRP trading at $81 a share, and last week it was actually in the 70s. Has anything changed really with the stock? Has my opinion changed? I just said, I was thinking about selling at 130. Has anything changed with my thoughts on this stock in particular? Am I still buying right now? Am I potentially considering selling? Obviously, the stock's getting hammered and it's a pretty cheap valuation, or it appears to be. So it really makes you beg the question, is something going on here? Has something changed? So I'll get into that and provide all my updated thoughts on this stock. So first we'll start off in the model. I also know I haven't taken this stock ever through my new model, so I figured I'd do that for you guys and show you guys really how well this business is being run, and then give you actually my DCF price and let you know what price I'm interested in buying at and what I think a fair value for the stock really is. Perhaps maybe you were somebody that bought the stock, after it ran up significantly. You got a little bit of FOMO, admittedly. It happens to the best of us, don't worry. Like when I first covered the stock, it was $84 a share back, mid last year, 2021, early 2021, I think. And it ran up to about, like I said, $128. Maybe you're somebody that bought it on that upswing. And now you're feeling pretty bad about your position because you might be down pretty heavy. So I want to really provide some perspective on, whether or not you bought a great company or not. And if it's going to do you any damage holding, or if you might be better off cutting your losses at this point. Also, something I do want to go over is I believe sentiment has changed around the stock for a good reason, and it presents a real potential risk of owning the stock. So I want to go over that risk and explain how, what honestly my thoughts are, what I'm doing, and if it really changes anything with the stock going forward. So definitely stay tuned towards that. I'll go over that kind of during my model towards the end. So for the liquidity solvency ratios, part of my ratio analysis tab in the model, you can see current ratio over the past couple of years has improved. So it's good to see. They're doing obviously a better job of improving their current liquidity. Current ratio obviously being their ability to pay off their current liabilities. So their current debts, things like that, due within a year using just their current assets. So things like cash, inventory, accounts receivable, things of that nature. It's really a good measure of short-term liquidity. If I see it over 1, it's pretty unlikely that this company is going bankrupt within the next year or so. And then cash ratio is a much more conservative measure where it basically takes your ability to pay off your current liabilities using just your cash. So it's a very conservative measure. I typically like to see this, above 0.5. 2020 it was, which is great to see. It has taken a bit of a step back, but I'm not too concerned about this because obviously, this is an ultra-conservative measure of liquidity. All in all, they do appear to be improving their financial position, which is good to see. Debt to equity ratio is negative every year. That's why this is blacked off. They actually have a negative equity balance, which I've covered in one of my last videos on the stock. Basically, they do have more liabilities than assets on the balance sheet. Can that get you into some trouble later? Potentially. If you have a ton of debt and, you don't have necessarily the assets to cover it, you could potentially be in for some hard times in the future. But why I'm not worried about this, one, is they significantly upped their debt in 2020. And obviously, you guys all probably know, if there was ever a time to take debt in your life, it was 2020, with interest rates cheaper than they've ever been. So yes, BRP has quite a bit of debt, but they actually refinanced their existing debt and took on new debt at incredibly low interest rates. So I think their average interest rate is around 3% or something. And when I get into their, return levels, their return on invested capital, you'll see it's pretty substantial. I feel incredibly fine with them, taking on a decent amount of debt. especially since they're generating cash flows, they're generating significant revenue growth, they're selling their products. It would be a different story if this business was looking a little shaky, but that's not quite the case. And I'll show you kind of more of that in a bit. So in terms of profitability ratios, one thing I really want to direct your guys' attention to here is gross margins. So, obviously gross margin is your revenue minus your cost of sales, basically the amount of profit you're able to bring in on just selling your products before, other expenses associated with running your business. You can see that gross margins have increased in 2020 and substantially in 2021. Now, if you guys have followed my other videos on BRP, you know what the issue has been over the past couple years. Semiconductor shortages have hit this company hard. They didn't really have enough supply to be able to meet the existing demand out there. And that's another really important point that we'll get into later, and something that makes me feel better about this company going forward. But like I said, I'll get into that in just a minute. First, regarding these gross margins, what this tells me, this substantial increase in 2021, is, especially with them selling all their supply, what this tells me is that they have pricing power. So because obviously supply is hard to come by and demand's pretty high, they're selling all the products that they can make. This shows me that they were able to raise the price of their actual vehicles, and they're able to get away with it because consumer demand for their products is still very high. So it shows to me that they have really, honestly, great products, which I already knew because I do own one. And you can go look that up. That sounds anecdotal, but you can go look up, customer reviews of these products. People love BRP, Sea-Doos, Ski-Doos, all that. They love them. They're great, highly rated products, highly quality products. What this tells me is they're actually able to, leverage what their customers believe their products are worth and charge higher prices and increase their profitability and their margins, which is really good to see. Profit margins have also increased in 2021. I'm not expecting 12% margins to be a thing going forward. It does obviously appear to be, kind of a anomaly associated with probably this high demand. And then free cash flow margin is negative. And you guys know I value free cash flow more than I do earnings. But why I'm not concerned about this is if we actually go to their financials, we go to their cash flow statement right here, you can see that, well, one, let's not avoid this issue. Operating cash flow has dipped. It is lower over the past 12 months than it has been in the past 4 years. But what you can also see is that capital expenditures are much higher than they've ever been and are currently higher than operating cash flow. So again, if you guys watch my past videos, you know this company is investing heavily into itself, into growing its own business. They're building a massive factory down in Mexico. They're actually investing money into battery development research as well. And they're trying to electrify their whole fleet. So they want an electric version of every single one of their product lines. So when we see negative free cash flow, but we also see that it's mainly a result of increased capex, we don't want to punish this company for reinvesting into itself. Especially, like I alluded to earlier, this company has an incredible return on invested capital. So I want this company reinvesting into itself. Let's actually go into that right now. If I scroll down, because they do have negative free cash flow this year, I'm not going to look at free cash flow metrics. We're going to kind of look at earnings metrics instead. Obviously, equity is negative, so that's going to be, ROE is going to be negative here. Return on assets is 19% over the past 12 months. Obviously, there kind of appears to be a little bit of an anomaly here in profitability, but you can see over the past, few years, it's trended in an upward direction and a pretty solid ROA regardless. Now, right here is where I really want to draw your attention to. ROIC. Look at these numbers. Look at this return on invested capital. 47% over the past 12 months. That's incredible. So like I said, I want this company investing everything that they can into themselves because they're generating an incredible return on doing so. So I'm completely fine with, CapEx being high in the short term because I believe, given their return on invested capital history, that they're going to generate incredible returns on the investments they're making into themselves, like this new factory, the battery technology. I think they're going to do incredible things with that, and they're going to grow massively in the future as a result. So that's why negative free cash flow over the past 12 months doesn't really concern me. Scrolling down, we can see EPS and free cash flow, with the exception of the past year, has increased steadily over the past couple years. And why I want to look at this as opposed to just net income is, EPS and free cash flow per share, that's what you own with your share in the company. When you buy a stock, you're titled to a share of the company's earnings, so the earnings per share. So in theory, a company could triple net income, but if actually tripled its shares outstanding at the same time, your individual share of that company's income that's tripled has remained flat because they've tripled the amount of shares outstanding. So when I see EPS increasing, it tells me, one, that earnings are increasing, and two, shares outstanding are likely decreasing or aren't increasing at a rate high enough to, dilute the increase in earnings. And so here's another important thing I want to draw you guys' attention to. You can see revenue growth over the past 3 years has been pretty insane. 15% in 2019 to negative 2% in 2020, but that's obviously pandemic related. They had to shut down their factories for a portion of, I think, Q1 2020. So that's understandable. We'd expect a bit of a pullback in revenue there. And then they more than made up for it in 2021 with revenues growing 20%. Now, I do not expect 20% to be the standard going forward. And that's actually going to bring me to a really important point that I want to address. And it's one of the reasons why I believe this stock has been hammered lately. I think a lot of people think that demand was pulled forward over the past 12 months. You know, a lot of future demand was pulled forward. People went out and they bought CDOOs in 2021 because that was the time to do it. Interest rates are incredibly low. A lot of pandemic closures. People are getting outside. People are buying CDOOs, stimulus checks, things like that. So I believe the market potentially is factoring in a bit of a decline from this 20%, which obviously I completely agree with that. I don't expect 20% revenue growth going forward to be a norm. I don't believe it's the main reason for the decline in share price, but I do believe it is a reason why, these shares appear to be trading fairly cheap. Now, if revenue growth does slow down a little bit, even over the next year or two, how is that going to affect your ownership and your return on the stock? We'll get into that when we get into my model, and I'll give my opinion on whether I think that's a huge issue or not. I also see there's a greater issue, a much greater issue, a bigger risk even, that's really manifested itself over the past couple months. And I think that in itself is more of the reason for the fall in share price. But quickly, share change, you can see. This is another thing I really want to highlight. 6% buybacks per year. That's insane. Like, they are buying back a ton of their shares. Now, it begs the question, do I want them to do this? Because, again, looking at their ROIC, incredibly high. Would I rather have them invest in themselves rather than buy back their shares? We'll get into that in just a minute, and I actually think it's part of a bet that the company's making on themselves and their own future performance going forward. Dividend, very sustainable, 18% of the past 4-year free cash flow. So I know some of you guys care about those dividends. It's not a huge dividend, so I won't pay too much time on that one. So when we get into my model, first, this is my very low case, like my worst case scenario happening. And I'll explain that in just a minute. But first, I want to explain what I believe the risk of this stock is and how this necessarily plays into my assumptions here, especially my low case. So what are the main reasons that sales could slow down for a company like BRP that sells, ski-doos, sea-doos, jet skis, things like that? Obviously, well, not jet skis, they're sea-doos, but you get what I'm trying to say. Recreational products. There's been a lot of fears lately of a potential recession that we could enter. And, if we start entering a recession and people are losing jobs potentially and things are expensive to buy, like obviously gas is going through the roof right now. If gas prices is really going to be high and that's, draining people's discretionary income, what is one of the things people are naturally going to, slow down on buying? It's fun toys like jet skis, like sea-doos, sorry. So if we do enter a recession, this is potentially a company that could get hit more than, say a needs-based company like, a grocery store or something. Also, another big risk is with interest rates rising or the threat of interest rates potentially rising in the future. How do a lot of people buy these products? Most people don't pay outright cash for these products. They finance them over years. Like you'll buy a CDOO with a 7 or 9 year term. And especially over the past couple of years with interest rates incredibly low, people have been more motivated, to finance these products. If interest rates do start to taper up, people might be a little less incentivized to finance a product like this because it's going to cost them more over the, length of the term. So those are a couple of really valid risks that I want each of you guys to be aware of. I want you guys to factor those into your decision, whether you own the stock or whether you're thinking about buying now. For me, it's very hard to predict. Obviously, for anyone, it's hard to predict whether we're going to go into a big recession or not, or whether even interest rates are going to, increase substantially. Nobody really knows. So the best thing for me that I can do is to be conservative going forward. So yes, things have changed with BRP. I will be lowering the price that I want to pay for this stock because my assumptions are going to be a lot more conservative, baking in the probability or the possibility that we could go into a recession and interest rates could really raise substantially. But before I really get into my assumptions, let's talk about the next risk here. The risk that demand was pulled forward. And as a result, revenues are going to decline a little bit because everyone went out and bought their CDOOs in 2020 and 2021. And now 2022, 2023, 2024, people aren't really going to be looking to buy these as much because they've already bought them. There's a couple reasons why I don't think this is a significant risk, and I don't believe this to happen. I could be wrong, but hear what I have to say and maybe provide your thoughts in the comments. Maybe I'm wrong. Maybe I'm completely wrong on this. First off, obviously supply shortages. They haven't been able to sell. They haven't been able to meet the demand. So yes, demand might have been pulled forward a bit, but it's being prevented. It's being limited from being pulled forward fully because they haven't actually been able to meet all the existing demand due to these supply shortages. And all the other companies are experiencing the exact same thing. So it's not even like, oh, BRP doesn't have any Sea-Doos or any Ski-Doos. I'm going to go to Yamaha or something instead. All these companies are dealing with the same problem. So, for example, this is a little bit of, again, anecdotal evidence, but because I know what's going on with this company and management's expressed the exact same problem, I'm able to extrapolate this and go, hold on, this is actually a real problem. This isn't just anecdotal. So my brother and I both own jet skis, and my brother actually tried upgrading and getting a new BRP Spark this past summer. And he called in and they told him it's going to be at least a year wait until he can get one because they're having trouble with their supply and they're selling out all they can make. That's just not going to make him want to, never get one. He just has to wait till next year. And a lot of other people are in the same situation. So I believe demand is actually going to be, stretched out over the next couple of years because of these supply constraints. But I could be wrong. And interest rates rising and, a potential recession could impact people's, capacity to want to go out and buy one of these. These are real risks. I want you guys to be completely aware of that. Another reason why I don't think demand was fully pulled forward is because they've actually got into new product lines. They entered the pontoon boat market, which is going to be a big revenue driver in itself. Their pontoon boats look so cool, man. I want to buy one so badly. So there's a new driver of revenue that didn't exist in the past. And then they're actually, like we talked about in my other videos, they're electrifying every single one of their product lines by 2025 or 2026. I think it's 2026. So over the next 4 years, first one's coming in 2023. But over the next 4 years, this company is going to have an electric version of every single one of its models. So I believe that's going to stimulate demand in the future as well, with some people naturally wanting to buy these electric versions. Where I think is going to be a really big market for these electric versions are things like rentals. Say you go to a resort and they let you rent, ski-doos and snowmobiles and drive them around. You bring them right back to the station and plug them right back in. That's, I think, going to be a huge thing for a lot of tourism companies because it's going to reduce their expenses. They're not spending as much money on gas, basically fueling these vehicles. So that's going to make them more profitable. So I think demand's going to be pretty high for these electric vehicles. But those are the risks. And so let's get into the model and see how those play in here. So right here in my low case, I have the absolute worst case scenario that I think could happen for BRP going forward over the next 5 years. And then here's a more high case, which I say high, but it's still very, very conservative, and you'll see why. I actually think this is a really, really realistic case here. And then I'll get into some more aggressive assumptions going forward. But I feel it's necessary to start with these. So, the low case. Revenue grows basically along with the industry, which is much lower than it ever has before, but it factors in a decay, a significant decay, potentially if we go into a recession and interest rates rise. Profit margins also decrease. So, they're not able to exercise this pricing power that they did in 2021 ever again. It's going to revert, profitability is going to revert right back to where it was before. Share change, like we said, they were buying back 6% of shares per year. I have this cutting by more than in half to negative 2.5%. And then trading at a terminal multiple of 10. So a 10 PE ratio, basically. So incredibly conservative. I don't actually believe these are realistic. This is a worst case scenario baking in if we have, a pretty bad recession. What these assumptions tell me is that this is a $62 stock today. Obviously trading at $81, that is substantially lower than it is right now. But keep in mind that's also for 15% return. So let's factor in what that would be for an 8% return. It's a buy. So say, in theory, you buy this stock tomorrow, or whenever I release this video, you buy it on Monday for $81 a share. You buy this stock for $81 a share, and my worst case scenario happens. We enter a terrible recession over the next 5 or so years. Buybacks slow down massively, profitability drops, sales drops substantially, and it's trading at 10 times earnings. You're still looking at around an 8% annual return, which is right in line with the market. So my worst case scenario that I have, maybe these are too aggressive. I don't see how you can see that. But my worst case scenario has this being around an 8% return over the next 5 years. And basically kind of matching the historic returns of an index fund. So I don't know about you guys, I don't think that's a bad call at all. Now let's flip this back to 15%, and let's say my, higher, more realistic assumptions come true. In these I have revenue growing at 9% per year, factoring in a bit of a slowdown over the next couple of years, and then, increasing in the future again as these new products roll out. Profit margins are able to stay a little higher, but not too high at all. They do revert back to that mean, but slightly higher than they were before, at 7%. Share change, share buybacks cut in half. Is that realistic when they've, over the past 3 years, been buying back negative 6%? Let's assume that they go for negative 6. You can see that substantially increases what I believe this stock to be worth. but I want to be conservative. So let's assume they cut buybacks in half and it trades at 10 times earning or 12 times earnings. Sorry. It's a $91 stock today for that 15% return. What I think is a realistic situation here is that this, slows down to about 4%, negative 4%. This is around a 10 multiple of earnings. This is incredibly conservative. And this stock's a buy right now for that 15% return. Looks like you're going to get about a 16% annual return buying. So keep in mind, this, like I said, this isn't my super aggressive case here. This is my realistic case. Now, if this company continues to perform incredibly well, we don't enter any sort of recession, let's bump that up to around 10% revenue growth. Let's keep margins the same. Let's leave the share buybacks. We'll drop them slightly to negative 5%, and then we'll leave that. It's a $104 stock for that 15% return. So what kind of return can you expect if these high cases come true? I don't love to do this because it isn't very conservative. I like to be rewarded with the upside. I love to use conservative assumptions and then be rewarded with it. But I just want to go through this and show you guys what you could expect if this company continues to perform and show a bit of the upside here. So if we up this to around 19%, wow, all right, 21%, 22%, you're looking at around a 21% annual return. If these high assumptions come true, which don't appear to be incredibly aggressive, let's bump that up to 20. 20% annual return if this comes true. I don't think that's unrealistic. But so now you kind of have an idea of what is priced into the stock, what the market kind of thinks. In actuality, what's going on here is that the market is baking in the reality that we could have a serious recession and interest rates could rise substantially. And then also revenues could be, have a bit of a pullback. But you saw my assumptions factor in all that. And that's going to get you about an 8% annual return. To me, I believe that's worth it. And that's why I'm buying the stock in the 80s. If this thing goes back into the 70s, I'm buying even more heavy. Even though I already do have a pretty substantial position in this stock. Like I said, it's not one of my biggest holdings, but it's a sizable position. My cost base is mid-80s. I'm really bullish on this industry. I think this is an incredibly well-run company. You saw the ROIC, you saw the ROA. And let's go back to the buybacks here. And let's think about why they're buying back shares so aggressively when their ROIC is so incredible. Why aren't they reinvesting this capital into themselves? Why are they buying back shares at such a high rate? And why are they continuing to buy back shares at such a high rate of 6% per year if we could potentially be going into a recession? I think management's honestly betting on themselves. I think they think that the company's future performance is going to be really solid, and they're buying back shares because they believe them to be incredibly cheap. They don't think this is a value trap, in my humble opinion, and I don't believe it necessarily is either. There are risks. The risk that we do enter a recession it's a sizable risk, but I factor those into my assumptions, and I'm okay buying the stock in the 80s. So ultimately, have things changed with my stance on BRP? Yes, and I factored that into these assumptions. I'm no longer personally buying the stock in the 90s. But in the 80s, in the 70s, I'm taking the advantage. If I see an opportunity there, I'll pounce on it, even though I do already have a decent position in the stock. But I kind of just want to provide my update on the stock because it has been a while. And maybe reassure some of you guys. Maybe some of you guys are panicking. You're thinking about potentially selling. I've been silent there. JP's been missing. Oh, what's going on? Is JP bailing on BRP? No, the answer is no. I'm not bailing. And I still feel great about this company. I bought a great company at what I believe to be a great price. Why would I sell? Why would anything change for me? Are there risks? Sure. But I've baked those into my assumptions, and I'm okay with buying at these prices. I'm okay with it. But that's it for my update on BRP. Appreciate it again. As always, you guys, let me know what kind of videos you want to see. Are there any specific Canadian stocks you really want to see me analyze? I know I teased that Loblaws video, but the stock price kind of shot up after that. And I don't really feel like it's not super intriguing to me anymore that I don't want to do a deep dive at this point. If it does draw back into the 90s, I'm really interested. But until then, I'm going to hold off on a deep dive. Just thought I'd update you guys on that. But let me know if there are any other stocks that you guys want to see me cover. And appreciate it again, as always. And take care, guys.